When I bought my first rental property, I thought I had officially entered the wealthy people game. The spreadsheets looked good. The YouTube videos made it sound inevitable. Buy property, collect rent, let the tenant pay the mortgage, repeat forever. That was the dream. And technically, on paper, the property even cash flowed when I first analyzed it. Then real life started. The first repair bill hit within months. Insurance increased. Vacancy lasted longer than expected. Maintenance costs stacked faster than rent growth. And by the end of year one, I had quietly lost thousands of dollars despite owning what everyone online called a great investment. But here's the part nobody tells beginner investors. The property itself was not the biggest problem. My assumptions were, because once I tracked every actual number honestly for 3 years, I realized something deeply uncomfortable about rental real estate. Most beginners are not analyzing investments. They are analyzing best-case scenarios emotionally disguised as math. If you like contents like this, hit like and subscribe so you don't miss our next video. Now, to be fair, this does not mean rental properties are bad investments. Real estate has created enormous wealth for millions of people over long periods of time. There are investors who bought correctly, managed risk well, survived difficult years, and eventually built life-changing portfolios. That part is absolutely real. The problem is that beginner investors are usually shown the ending of the story without understanding the financial pressure required to survive the middle. Nobody uploads videos about replacing plumbing systems at midnight or covering vacancies from personal savings while pretending everything is passive income. And that creates a dangerous expectation gap. Because when your property underperforms early, you assume you personally failed instead of realizing most real estate returns depend heavily on surviving long enough for leverage and appreciation to eventually work in your favor. That distinction matters. My property was not uniquely terrible. In fact, compared to many beginner deals, it was relatively average, which is exactly why the numbers became such an important wake-up call psychologically. So let me show you exactly what happened financially during those first 3 years. Year one looked survivable at first. Rent covered the mortgage most months, and I convinced myself the property simply needed time to stabilize. Then the hidden costs started arriving one after another. A plumbing repair wiped out almost 4 months of projected cash flow immediately. Insurance premiums increased at renewal. A tenant turnover created vacancy plus repainting expenses simultaneously. Suddenly, the property that looked profitable inside the original spreadsheet was quietly running negative despite full occupancy most of the year. Year two became psychologically harder because now the losses felt personal. Every unexpected expense triggered frustration. Because the investment was no longer matching the story, I had sold myself emotionally before buying it. And year three finally forced me to analyze the numbers honestly instead of optimistically. That's when I realized beginner investors usually underestimate one thing more than anything else: how thin their actual financial margin becomes once real operating conditions replace theoretical projections. The hidden costs were what completely changed my understanding of rental real estate. Not the mortgage, not the obvious expenses, the unpredictable operational friction nobody includes emotionally when imagining passive income. 1 month, the HVAC system failed during summer and immediately erased nearly 6 months of projected profit. Another month, a tenant paid late, which forced me to cover the mortgage personally while already handling maintenance expenses simultaneously. Then property taxes increased after reassessment, which permanently changed the monthly math going forward. And the dangerous part is that none of these events were unusual. That's what shocked me most. Every experienced investor I later spoke with treated these situations like completely normal operating conditions. But beginner investors usually analyze deals assuming stable rent collection and minimal interruptions because that version of the spreadsheet feels emotionally safer before buying. In reality, the property was constantly demanding additional capital injections to stay operational smoothly. And once I tracked those injections honestly, the passive income narrative started looking dramatically different financially. By the end of year one, after repairs, vacancy, insurance increases, and maintenance, the property was roughly $4,300 negative overall. Year 2 improved slightly operationally, but another turnover plus appliance replacement pushed total losses close to $3,000 again. And by year 3, even though rent finally increased modestly, property taxes and ongoing maintenance continued absorbing most of the additional income immediately. Altogether, across 3 years, I lost well over $10,000 in direct cash flow despite owning a property that technically appreciated in value during that same period. And this is where real estate math becomes psychologically confusing for beginners. Because on paper, some investors would still call the deal successful due to equity growth and loan paydown. But emotionally, writing checks constantly into an investment changes how passive income feels in real life, especially when those cash injections happen unpredictably. That was the moment I finally understood something important. Leverage can absolutely build wealth long term. But during the early years, leverage often feels financially heavier than beginner investors emotionally anticipate beforehand. Now, here's the important part most anti-real estate arguments ignore completely. If I had sold the property emotionally during those difficult early years, I probably would have locked in the worst possible outcome financially. Because real estate investing often rewards durability more than perfection. The investors who eventually win are usually the ones who survive long enough for rent growth, appreciation, mortgage paydown, and inflation to gradually improve the math over time. And to be fair, that eventually started happening with my property too. By year 4, the losses slowed significantly. By year 5, the property finally became modestly cash flow positive consistently. So this is not a real estate is fake wealth argument. It's a real estate is operationally harder and emotionally slower than beginners expect argument. Those are very different things. The problem is not that rental properties cannot build wealth. They absolutely can. The problem is that many people buy highly leveraged assets expecting immediate financial freedom instead of understanding they may first need years of patience, reserves, and financial resilience. The real lesson from those 3 years was not never buy rental property. It was understanding the difference between theoretical wealth building and operational wealth building. Theoretical wealth building happens inside spreadsheets, podcasts, and social media clips where every month runs smoothly and appreciation solves everything eventually. Operational wealth building happens in real life, where assets create stress, unpredictability, and temporary setbacks before they create freedom. And honestly, that distinction changed how I evaluate every investment now. Because an investment is not truly good if it only works emotionally during ideal conditions. A durable investment survives in perfect conditions repeatedly without destroying your financial stability or mental bandwidth completely. That's what beginner investors underestimate constantly. The emotional carrying cost matters too. Liquidity matters. Margin matters. Flexibility matters. And once I understood that, I stopped chasing investments that looked impressive online and started prioritizing investments I could realistically survive through difficult periods long enough for compounding to actually work. That shift completely changed my financial decision-making afterward. What's interesting is that if you looked at my property today without understanding those first 3 years, you would probably assume it was always a successful investment. The equity looks solid now. Rent eventually increased. The cash flow stabilized. From the outside, it resembles the exact type of real estate success story people celebrate online constantly. But that's why I want to show the ugly middle honestly. Because most investments only look obvious in hindsight after enough time passes. During the difficult years, the experience feels completely different emotionally. And that's the part beginner investors almost never prepare for correctly. The real question is not whether an investment can work eventually. The real question is whether your finances, psychology, and liquidity are strong enough to survive the years before it works fully. That's the difference between theoretical investing and real investing. If this changed how you think about rental property, subscribe right now, because the next videos are going to break down the hidden math behind several wealth building strategies most people never analyze honestly enough beforehand.